Have you ever watched a movie and just thought it was horrible? But then you talk to your friends and all of them say, "Oh, that was the best movie I've ever seen. The acting was off the charts. I'm going back to watch it again." You're like, "What? Are we talking about the same movie here? Because that was the worst movie that I've ever seen. It was so boring. And I love you, buddy, but there's no way I'm going to waste another 2 hours of my life watching that thing again." Have you ever felt similar to this with your money? Someone tells you this is the thing to do with your money. All of the high rollers, banks, corporations, wealthy individuals do this with their money. You need to do it. But then you look at the numbers and they just don't make sense to you. You're like, what am I missing here? So let's relate this to whole life insurance because this happens all the time, especially when someone's interested in a whole life insurance policy because of the cash value. We'll talk about a guy named Rick. So Rick was told that putting money into a whole life insurance policy is a fantastic idea. The thing is, Rick had looked at whole life insurance before. And when he looked at it, he said, no way. When I'm paying money into this product, it takes at least 7 years to get my money back, meaning he's running a loss for the first 7 years. He said, that is a huge lost opportunity cost. I'll just keep investing in real estate. It's not for me. When he hears people talk about whole life insurance, he kind of goes, oh, great, this again. I don't get it. But then one day, he talks with a friend of his. Now, his friend is also a mentor who invests in real estate. He's extremely successful. And his friend says to Rick, you should really consider a whole life insurance policy. It's how I buy all of my property. It's one of the best places to put my money. Now, when Rick hears this, he knows that his friend does his due diligence. He does his homework, and he's not going to do anything foolish with his money. What do you think Rick is asking himself now? What am I missing here? Because when he looked at the numbers, they didn't make sense to him. Have you ever felt like this with whole life insurance or with anything? I feel like it happens all the time with one thing or another. So we're going to try and help out Rick today. Hopefully this video applies to you too. What was Rick's biggest concern with whole life insurance? It took more than 7 years just to get his money back. So here's what we will cover today. We'll talk about the following. Number one, we'll talk about how to maximize the cash value in a whole life insurance policy, because that's why Rick did not do it initially. The cash value was not attractive. And then we'll talk about what not to do and what to do. And we'll look at numbers all the way through. Let's have some fun. So we'll start with what most people see. We're going to look at a 40-year-old individual that's paying $10,000 per year for 10 years. Simple math, that's a total of $100,000 out of pocket. And we'll look at 3 options, A, B, and C. Now, all of the options will be the exact same product. We're going to look at a policy with Guardian, which is one of your 4 major mutual companies, paying $10K per year, same company, same product, but what you're going to see is some options are going to give you more cash value without having to pay more. For Rick, it's the same $10K per year. Okay, so let's get on into it. Let's look at option A. So what do we have here? We've got a premium of $10K per year. We see that he's paying $10K per year for how long? A total of 10 years in this example. After the 10th year, he pays 0 every single year. Now, look at your cash value in the first year. What do you notice here? Almost a 0, $336. When does he get his money back? It's by year 12 in this particular example. That's a long time just to get your money back. Option B, exact same product with the exact same company. What do you notice here? Your premium is $5,000. Then you have what is called your paid up additions rider, your PUA rider. I like to call this a cash dump-in for another $5K. Add the 2 together. We've got our $10K per year going in for 10 years here. Look at your first year cash value. You've got about $5,000, and it takes between 7 and 8 years to get your money back. This is similar to what Rick was shown. Different numbers, but first year cash value, close to half of what he paid in, and takes 7 years just to get his money back. Looked at this and said, nope, not interested, takes way too long to get my money back. Option C, same product. Look at your premium, less than $1,000. The rest goes toward that paid up additions rider, the cash dump-in, we like to refer to it as. You've got $10K per year going in. Look at your first year cash value. You're getting close to 88%. You get all of your money back in 4 years. So you have a minimal hit up front, get your money back in 4 years. So when we look at the options side by side, which one gets you your money back faster? Well, option C, it's the clear winner. Let's look at it in the first year alone. So option C has more money than both options A and B. And again, same policy with the same company. How about after 10 years? What do you notice here? Well, option C still has the most money. It's substantial too, because he's paid a total of 100 grand. Here he's got about 119. Option B is not a close second. It's at 107. Let's look at it longer term. How about by year 20? We've got 191. Option C is still the winner. Then by year 30, option C is still the winner. So from start to finish, we've got the most money with option C. A question that comes up sometimes is this: why? Because again, it's the same insurance company, it's the same product, and it's the same out of pocket. Why is there a difference here? It's how the policy is set up. So if this is you paid $10,000 per year into options A, B, and C, but they had different results. The difference was where your money was going. It can go toward your base premium or your paid up additions rider. That is the key. Base premium dollars first buy you life insurance and then eventually build cash value, whereas PUA dollars first build cash value. We see it show up immediately, and they also get us life insurance. So if we look at A, B, and C again, A had everything going toward the base premium, and we had minimal cash value in the first year. Option B had a 50-50 split, 5,000 premium, 5,000 PUA. Then option C had a base premium of 1,000, was actually less than that, it was $900 and change, but a minimum premium and a maximum PUA rider. That's what juiced our cash value. So why this happens, or I should say, Rick was shown option B. He never knew about option C when he was first shown this years ago. Why not? There's always two reasons why. Number one is lack of awareness. He doesn't know what questions to ask. He only knew later because his friend brought it up. And then number two, this sometimes has a motive, the agent commission. So here's a quick overview of how the commissions work. And this is exactly what our company would receive if we sold this product with the different setups. So what do you notice? Option A, in the first year, we'd make $8,500 and more than 13 grand over 10 years. Option B, we'd make about $4,400 and over a 10-year period, about $8,300. And then option C, we make about $1,100 and over 10 years, $4,200, or call it $4,300. And this is not just us, meaning it's not just our insurance company. This is what most agents would receive in the industry. If they haven't been producing for a long time, it might be a little bit less. But my point is, commissions are typically standard across the board from company to company. This company does pay significantly lower commissions than most, just in our experience. So, key takeaway here, if you're interested in a policy for cash value, that's why you want to put money into it. Ask about minimizing the base premium and maximizing the PUA rider. The example we saw, we had about a 10% minimum premium. Here's a question that comes up sometimes. Do I get a $10,000 bill if I have a policy like this? The answer, no, you do not, which is very nice. So here's what you're billed for, the actual base premium. Adding money to your PUA rider is 100% optional. Now, the company's flexibility features are very important, but my point is we can set it up where we're only committed to the 1,000, and then we can add up to another 9,000, 100% at our discretion. So here's what most people do. If someone says, I want to fund up to $10,000 per year, what we'll do is set it up where they are committed to about $1,000 per year, and they can add another $9,000 at their discretion. If they said, I want to be able to pay $100,000 per year. Well, in that case, multiply everything by 10. We took the premium at $10,000, so they're committed to that every year, and they can add up to another $90,000 per year. They're not required to do that though, which is very nice. So this is how we make a policy very flexible. This has helped a lot of people because what we often see is individuals are attracted to whole life insurance because of the cash value for the core benefits. When you look at the cash value, it's a safe place to put money. It's liquid. I can access it like a personal line of credit, meaning you can borrow against the policy while you keep on earning interest on the money that you haven't borrowed and what you've borrowed. That's point number 2. And then point number 3, the tax advantages. If we do it all right, we can access it tax-free very easily. But if I make it flexible, where I don't feel like I have to pay this huge premium every year and it stresses me out, now all of a sudden, if I don't feel like that, I can commit to a small amount and shovel extra funds into the cash value at my discretion. This is where people are often very attracted to this product with this type of setup. So when we look at the flexibility with option C, what's your minimum? There you go, $1,000 per year. All right. To recap, how do I maximize the cash value in a whole life insurance policy? Here's what I would do. I'd minimize the base premium, maximize the PUA rider. I'd want the awareness that most of the top life insurance companies, like your 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, will usually allow about a 10% base premium. Some are a little bit lower, some are a little bit higher, but look for that general range with most of their products. And what that means is that 10% of your total payment is going towards the base premium. So if you're paying that $10K per year, you've got a $1,000 base premium, or it's set up where it's very flexible, so you're only committed to $1,000, and you can add another $9,000 at your discretion. A lot of people like that. And then the rest can go toward your PUA rider. That's the money we add at our discretion. So what not to do, and then what to do. Let's start with what not to do. I would not recommend getting a policy with a high base premium for 2 reasons. I'm going to have less cash value, especially up front, and I'm going to be committed to that premium. Remember, in red is what I'm committed to. That's the base premium piece. Sometimes I hear this, that the base premium gives you the real long-term growth or real long-term compounding. I say no. That argument does not have any proof behind it, not what I've seen. It's typically based on an illustration and how dividends are applied to whole life insurance policies, but I haven't seen this actually happen. If it does happen, it's going to take 30 or 40 years of having less money up front before I finally see a little bit more. So we typically do not recommend a higher base premium. Here's what I would do. I'd get a policy with a low base premium. Low is all relative to the total amount that you're paying in. I would look for a company that offers a flexible PUA rider. This can be a good idea if your cash flow fluctuates. So a lot of times we'll work with people that say, I want to be able to pay in this much money, say it's $100,000 per year, but the idea of stroking a check for $100,000 every single year does cause me a bit of stress, which takes my focus away from other things that I like to do. So I would say, thank you for sharing that. What I might recommend then is a company that lets you commit to, call it $10,000 per year. Does that stress you out? No, that doesn't. Okay, great. So you can commit just to 10, and then you can add up to $100K per year, and you can do that through your mobile app, your online portal. You can set it up to be very, very flexible, which is nice. And then I would always recommend at least looking at one of the 4 major mutual companies because we've seen proof of performance, not just good-looking illustrations on paper. So if you set the policy up right, you'll have maximum cash value from start to finish. Maximum cash value means that you'll have more money. More money for what? Could be anything. Here are a handful of examples. Opportunities, that could be real estate, my business, maybe it's my kid's college, maybe I just want to beef up that cash value so I can take more income during retirement, or it could be anything that you want. So I do hope that this video was helpful. Please let us know your thoughts below, and I hope this helps. Have a great day.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.